Hello. In the previous sessions, we discussed about the concept of cost volume profit analysis, right, where we discussed the concept of break even point, the concept of margin of safety, etc. In today's class, we will discuss few problems and their solutions related to the CVP analysis. So problem number 1, right, a company sells a product for 50 rupees per unit, the variable cost per unit is 30 rupees and the fixed costs are rupees 2 lakh per year. Calculate the break even point in units. And as we discussed earlier, break even point is the amount of sales at which the company is at no profit, no loss zone, right. So, what is the formula? Formula is break even point in units is equal to fixed cost divided by selling price per unit minus variable cost per unit. So, the fixed cost is given here, you can see that is rupees 2 lakh. So, rupees 2 lakh divided by selling price per unit, that is 50 rupees minus 30 rupees, that is the variable cost per unit. So, 2 lakh by rupees 20 is 10,000 units is the break even unit, right. So, problem number 2, this was problem number 1, now problem number 2, another problem. A business has fixed cost of rupees 1 lakh 50, a selling price of 60 per unit and the variable cost of rupees 40 per unit, right. How many units must be sold to achieve a target profit of 50,000. So, till in the previous problem we calculated the number of units to reach the break even, that is the zero profit point. Now, in this problem we are discussing that for having a target profit of 50,000 rupees, how many units needs to be sold. So, the formula is required sales in units is equal to fixed cost plus the target profit divided by selling price per unit minus variable cost per unit. If you look at this, the selling price per unit minus variable cost per unit, you remember that this is actually nothing but the contribution per unit. So, I am putting the values here. So, fixed cost is equal to 1,50,000 plus the target profit is 50,000 divided by 60 rupees is my selling price per unit and variable cost per unit is given is 40 rupees per unit. So, 20 rupees is my contribution per unit. So, rupees 2 lakh divided by rupees 20 is 10,000 units, right. So, the company needs to sell 10,000 units to achieve a target profit of rupees 50,000 if the fixed cost is rupees 1,50,000 and the selling price is 60 rupees per unit and variable cost is 40 rupees per unit. Problem number 3, if the company wants to make a profit of rupees 1 lakh and its fixed costs are rupees 2,50,000 with a contribution margin per unit of rupees 25, how many units it must sell, right. So, here you see the target profit is given, it is rupees 1 lakh and fixed costs it is given rupees 2,50,000 and contribution margin is given that is 25 rupees per unit. So, it needs to sell how many units? So, the formula is what? Required sales in units is equal to fixed costs per target profit divided by contribution margin per unit, right. So, fixed cost is given here rupees 2,50,000 plus 1 lakh is my target profit divided by rupees 25 is contribution margin per unit. So, if I solve 2,50,000 plus 1 lakh is 3,50,000 divided by rupees 25. So, number of units is rupees 14, number of units to be produced is 14,000 units. Okay. So, this was problem number 3. let's come to before going to the next problem, let's quickly recapitulate the concepts which we discussed earlier. The first one is that in break even point, what we discuss is basically the point where the level of sales at which it is at no profit, no loss zone, right. So, so anything above break even point, it gives us a cushion. Now, if you remember, we discussed equation in previous session, that in marginal costing we divide the total cost into two parts. One is the variable cost and the fixed cost. Variable cost is that part of total cost which varies with the level of sales, right, within a given time frame and within a given level of production. Fixed costs are those costs which doesn't change with a change in level of production within a given time frame and within a given production range, right. So, the cost behavior of these two types of costs are different, right. The variable cost per unit remains unchanged with the change in level of production, but total variable cost changes, right. The variable cost per unit remains unchanged, but total variable cost changes with the change in level of production. In the case of fixed costs, however, the total fixed cost remains unchanged with the level of change in production, but fixed cost per unit, right, it changes, right. So, what are the examples of variable cost? The biggest example, most prominent example of variable cost could be the cost of direct material. So, direct material cost is usually increases if the production units, if the production level increases, and it reduces if the production level reduces, and most of the time it also changes proportionately. What could be the example of a fixed cost? A fixed cost could be a cost which doesn't change with the level of production within a given production. Like for example, rent paid for say factory sheds, right, rent paid for factory sheds. So, rent paid for factory sheds, it remains unchanged, right, unless we change the overall capacity, fine. So, these are the examples of fixed cost. There are however few costs which are kind of semi variable costs, which are partly fixed and partly variable. So, these costs change with the level of change in production units, but it does not change proportionately, right. Okay. So, we are going to the next example. So, problem 4. A company has fixed cost of 1,20,000, a variable cost per unit rupees 15, and sells each unit for rupees 45. Calculate the contribution margin ratio. The contribution margin per unit is equal to selling price per unit minus variable cost per unit. So, selling price per unit is 45, variable cost per unit is 15. So, my contribution margin is 30. So, contribution margin ratio is equal to contribution margin per unit divided by selling price per unit into 100, right. So, 30 rupees is my contribution margin, selling price is 45. So, 30 by 45 into 100. So, it is coming to 66.67%, right. If you remember, we discussed the equation for calculation of contribution. It is selling price SP minus variable cost, it gives you the contribution, and if you deduct from contribution the fixed cost, you get the profit, right. So, in case of marginal costing, we give lot of importance to variable cost, because in the short run, right, you can influence the variable cost, right, but easily, but influencing the fixed cost is difficult. So, this is the reason. Next problem, problem 5, given a selling price of rupees 100 per unit. So, selling price is rupees 100 per unit and variable cost is rupees 70 per unit and fixed cost is rupees 3 lakh. Determine the sales in rupees needed to break even. So, basically it is asking for the break even sales, right. So, here is the solution. Contribution margin per unit, you know that it can be calculated by deducting the variable cost from the sales price. So, selling price per unit minus variable cost per unit. So, 100 is my selling price, 70 is my variable cost. So, I got the contribution margin per unit. Break even sales, to calculate the break even sales, what I can do is I can divide the fixed cost with the contribution margin ratio. So, contribution margin ratio is 30, 100, because here we calculated that the contribution margin per is 30 and selling price, you see it is given as 100. So, 30 by 100 is 0.3. So, break even sales is equal to 3 lakh, right. 3 lakh is my fixed cost, right, divided by the contribution margin ratio 0.3. So, it is coming to 10 lakh, rupees 10 lakh. So, this it is coming to rupees 10 lakh. So, this implies that if the company is been able to sell units worth 10 lakh, then the company will reach at a no profit no loss situation, no profit no loss situation. So, if it moves above, if the sales moves above 10 lakh, right, company will be in the profit zone, right. But if the sales falls below 10 lakh, then the company will remain at loss. Next problem, sixth problem, the company has fixed cost of rupees 5 lakh, a selling price of rupees 150 per unit and a variable cost of 100 per unit. If the company sells 15,000 units, what is its profit, right. So, fixed cost is given rupees 5 lakh, the selling price is given 150 rupees 150 per unit, a variable cost is given 100 per unit and the company sells 15,000 units. So, what is its profit, right. So, contribution margin per unit is selling price per unit minus variable cost per unit. Selling price per unit is 150 and variable cost per unit is 100. So, the difference is 50 rupees, right. So, total contribution is equal to contribution margin per unit into units sold, right. So, total contribution is 50, contribution margin per unit we calculated here, this is 50. So, 50 into units sold 15,000. So, it is coming to rupees 7 lakh 50. So, this is my contribution. To calculate the profit, what we need to do is we need to for calculating the profit, what we need to do is we need to deduct the fixed cost from the total contribution. So, total contribution we calculated 7 lakh 50 and fixed cost is given, it is 5 lakh. So, my profit is 2 lakh 50,000. So, if the company sells 15,000 units, it can earn a profit of rupees 2 lakh 50,000. So, this is my answer. Okay. Fine. Problem number 7, right. Next problem, a company's contribution margin is 40%, right. Contribution margin we discussed earlier, the contribution margin formula is contribution per unit divided by selling price per unit, right. And if I multiply this with 100, I will get the answer in percentage. So, the contribution margin ratio for a company, it is 40%, and its fixed costs are given as 2 lakh. I need to calculate the break-even sales in rupees, right. So, I need to calculate the break-even sales in rupees. So, break-even sales rupees is fixed cost divided by contribution margin ratio. So, fixed cost is given, it is 2 lakh divided by 0.4. So, it is coming to 5 lakh. That means, if the company sells worth rupees 5 lakh, it will reach at no profit, no loss zone. Anything any additional sales if the company makes beyond 5 lakh, the company will be able to make profit. Now, one thing you must have noticed here, that in this break, if in this equation, if this fixed cost element is high, right. Suppose if the fixed cost element is high, then you see the level of break even sales is supposed to increase at the same contribution margin, right. So, a company usually, if it increases, right, its fixed cost element in the cost structure, the company needs to decide that in the cost structure how much they want to keep as fixed and how much they want to keep as variable. Now, if the company decides, if the management decides that the fixed cost part of the total cost structure will should be high, then in that case the break even sales will be also on the higher side. Now, the company usually takes this kind of decisions to keep the higher break even sales if they are more or less certain about the sale, right. If they are more or less sure that they will be able to achieve a high volume of sales, right. That may be because of the nature of product or the nature of demand available in the market, right. This is a crucial decision because this entire capacity, the production capacity building, it is this is the pivot point for that, right. So, if the company decides that they want to keep the break even sales on the higher level, right, then they have to create this production capacity, right. For production capacity, they need to invest money, right, and they need to invest for manpower, right, maybe trained manpower or untrained manpower. So, all these resources they need to accumulate before going for this, right. On the other hand, if they keep this fixed cost level low, right, then what will happen? The break even sales will also be low, right. But you see, if the fixed cost is, if the company keeps the fixed cost level on the higher side, right, and variable cost on the lower side, right, then what will happen? If the variable cost is low, at a given at a given sales price, right, this contribution margin will also go up, right. So, there has to be a fine balance. I am giving you one example. Say a company, suppose company needs manpower, right. Now, when the company needs manpower, company has a couple of ways to do that, employ people. One is that they can employ permanent employees, right, at a fixed salary, right. So, this salary paid to the employees we can consider as fixed cost. Why? Because even if the production level changes in the short run, the company may not be able to terminate their services and reduce the employee cost, right. So, it is a kind of fixed cost. The other way is they can employ the casual workers on daily wages. So, on daily wages, if the production level falls, they can they can reduce their employee cost proportionately, right. So, but if the company decides to employ highly skilled workers, then they may have to go for only for the fixed monthly salary, right, permanent employee mode, because if they adopt the casual employee mode, then the highly trained employees may not be available, they may not be interested in applying for the job, right. So, the company needs to decide that for production which type of technology they will adopt. So, if they adopt the advanced technology, then they have to go for permanent workers. So, in that case the fixed cost will increase. If the fixed cost increases, the break even sales will also increase. Then the company has to ensure that they will be able to match this higher level of break even sales. So, these are finer nuances which the management has to think of, right. And at many point of time these decisions are irreversible. That means, if the decision has been taken, it is very difficult to reverse it, take an opposite stand, particularly at a shorter time frame, right, shorter time period. So, these are very crucial decisions. Many a times these decisions are taken by the top management, right, and a company can make or break, success or failure depends a lot on these decisions, that what will be the cost structure, what will be the sales price. In such cases, the cost volume profit analysis plays a very crucial role. Next problem, problem 8. The fixed cost of a firm are 1,80,000. The contribution margin per unit is 60. What is the break even point in units? So, it is simple now. Break even point in units is equal to fixed cost divided by contribution margin per unit. Fixed cost is already given 1,80,000. Contribution margin, it is already given 60. So, it is 3,000 units. Now, if you know the selling price, in this question the selling price is not given. If you know the selling price and if you multiply 3,000 units with the selling price, you can calculate in terms of rupee, right. Okay. Problem 9. A company sells a product for rupees 200 per unit and has a variable cost of rupees 120 per unit. If fixed costs are 1,60,000, what is the contribution margin ratio, right? Okay. So, contribution margin ratio, we earlier also in one problem we calculated this. So, contribution margin per unit is, we know now, selling price per unit minus variable cost per unit. So, 200 minus 120, so it is 80, and contribution margin ratio is contribution margin per unit divided by selling price per unit into 100. Contribution margin per unit we already calculated 80, and selling price, you see, it is given here 200 into 100. So, answer is 40%. Okay. So, this is my contribution margin ratio. Problem number 10. A business expects fixed costs of rupees 2,50,000, a contribution margin ratio of 50%. How much sales revenue is needed to achieve a profit of rupees 1,50,000? So, required sales, I can do the solution like this. Required sales in rupees is equal to fixed cost plus target profit divided by contribution margin ratio. Fixed cost is 2,50,000 plus target profit is 1,50,000 divided by the contribution margin ratio, that is 50%, 0.5. So, if I solve, it is coming to rupees 8 lakh. So, the company needs to sell worth rupees 8 lakh for getting a profit of rupees 1,50,000. Thank you.